Question 1. Which of the following types of reinsurance contracts best protects a primary insurer from catastrophic losses on individual large policies? A. Proportional reinsurance. B. Quota share treaty. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is a non-proportional type of reinsurance that provides protection to the primary insurer against large individual claims exceeding a certain retention limit. Unlike proportional reinsurance, where both the primary insurer and the reinsurer share the premiums and losses, excessive loss reinsurance covers the amount of loss that exceeds the agreed-upon limit. This makes it an effective tool for managing catastrophic risks. Question 2. Under Ohio insurance regulations, which scenario would require a reinsurer to notify the director of the Ohio Department of Insurance? A. A reinsurer opens a new branch office within Ohio. B. A reinsurer adjusts premium rates by 2%. C. A reinsurer assumes business from a non-admitted insurer. D. A reinsurer fails to maintain the required solvency ratio. Answer: D. A reinsurer fails to maintain the required solvency ratio. Explanation: Ohio law requires reinsurers to maintain financial solvency and meet capital requirements. If a reinsurer fails to meet the minimum solvency ratio, it must notify the director of the Ohio Department of Insurance. Solvency regulations help ensure that the reinsurer can meet its obligations to policyholders and other insurers. Question 3. Scenario-based. Mr. David, a primary insurer's risk manager, is reviewing policy covering large industrial plant. He is concerned about the plant's exposure to natural disasters. He decides to purchase reinsurance but is unsure whether to choose facultative or treaty reinsurance. What type of reinsurance would be most appropriate for this situation and why? A. Facultative reinsurance, because it provides flexibility to cover large individual risks. B. Treaty reinsurance, because it automatically covers all risks underwritten by the primary insurer. C. Proportional reinsurance, because it shares the risk equally between the insurer and reinsurer. D. Excessive loss reinsurance, because it protects against catastrophic losses. Answer: A. Facultative reinsurance. Explanation: facultative reinsurance is ideal when the primary insurer wants to reinsure a specific risk or policy, such as a large industrial plan. Unlike treaty reinsurance, which covers a portfolio of risks, facultative reinsurance allows the reinsurer to assess and decide whether to accept the particular risk. This is beneficial for high-value or unusual risks that require individual attention. Question 4. What is the primary purpose of the Ohio Insurance Guarantee Association in the context of reinsurance? A. To provide financial assistance to insolvent insurers. B. To regulate premium rates for reinsurance contracts. C. To ensure that reinsurers maintain adequate reserves. D. To facilitate the licensing of foreign reinsurers. Answer: A. To provide financial assistance to insolvent insurers. Explanation: the Ohio Insurance Guarantee Association provides a safety net for policyholders by covering claims against insolvent insurers. This ensures that policyholders receive their due compensation even if their insurer becomes insolvent. Reinsurers, however, are generally not covered by guarantee associations, as they are expected to maintain sufficient reserves to manage obligations. Question 5. Which of the following types of reinsurance contracts automatically covers a specific class of risks without requiring individual risk approval? A. Facultative reinsurance. B. Quota share treaty. C. Excessive loss treaty. D. Surplus line treaty. Answer: B. Quota share treaty. Explanation: a quota share treaty automatically covers a specified percentage of every risk within a defined class of business. The primary insurer cedes a fixed percentage of the risk to the reinsurer and receives the same percentage of the premiums. This arrangement reduces the insurer's exposure across a wide range of policies. Question 6. In Ohio, reinsurance agreements must include certain provisions to protect the interests of the ceding insurer. Which of the following is one such provision? A. The reinsurer must maintain a physical office in Ohio. B. The agreement must allow the ceding insurer to cancel the contract at any time. C. The agreement must specify the reinsurer's liability in case of insolvency of the ceding insurer. D. The reinsurer must assume all claims without any retention limit. Answer: C. The The agreement must specify the reinsurer's liability in case of insolvency of the ceding insurer. Explanation: Ohio regulations require reinsurance agreements to address the reinsurer's obligations in the event of the ceding insurer's insolvency. This provision ensures that policyholder claims are paid even if the primary insurer becomes insolvent, thereby safeguarding the interests of policyholders and maintaining trust in the insurance system. Question 7. Which Ohio regulation requires a reinsurer to provide a letter of credit or other collateral to secure its obligations to a ceding insurer? A. Ohio Revised Code 3901.61. B. Ohio Administrative Code 3901312. C. Ohio Insurance Guarantee Act. D. Ohio Financial Responsibility Law. Answer: B. Ohio Administrative Code 3901312. Explanation: Ohio Administrative Code 3901312 sets forth the rules regarding security and collateral requirements for reinsurers. Reinsurers that are not licensed in Ohio must provide acceptable collateral, such as a letter of credit, to secure their obligations. This requirement ensures that the ceding insurer has financial protection if the reinsurer fails to meet its obligations. Question 8. Scenario-based. A primary insurer based in Ohio has a $10 million policy covering a sports arena. The insurer decides to obtain excessive loss reinsurance with a $5 million retention limit. After a severe weather event, the insurer incurs $8 million in covered damages. How much will the reinsurer be responsible for paying? A. $3 million. B. $5 million. C. $8 million. D. $10 million. Answer: A. $3 million. Explanation: in an excessive loss reinsurance contract, the reinsurer is only responsible for losses exceeding the primary insurer's retention limit. In this case, the retention limit is $5 million and the total loss is $8 million. Therefore, the reinsurer will pay $3 million, the amount exceeding the retention limit. Question 9. According to Ohio regulations, which of the following would be considered an unauthorized reinsurer? A. A reinsurer licensed to do business in Ohio. B. A reinsurer approved by the National Association of Insurance Commissioners (NAIC). C. A reinsurer based in a foreign country without approval from the Ohio Department of Insurance. D. A reinsurer that has posted collateral in Ohio. Answer: C. A reinsurer based in a foreign country without approval from the Ohio Department of Insurance. Explanation: an unauthorized reinsurer is one that does not have a license or approval to operate in Ohio. Ohio law requires reinsurers to either be authorized by the Ohio Department of Insurance or post collateral to ensure they can meet their obligations to the ceding insurer. Foreign reinsurers must comply with these rules, avoid being considered unauthorized. Question 10. Which of the following best describes a cut-through clause in reinsurance contract? A. Clause that allows the reinsurer to cancel the contract at any time. B. Provision that enables the reinsurer to deal directly with the original policyholder in case of the ceding insurer's insolvency. C. Clause that limits the reinsurer's liability to specific amount. D. Provision that automatically renews the reinsurance contract. Answer: B. A provision that enables the reinsurer to deal directly with the original policyholder in case of the ceding insurer's insolvency. Explanation: cut-through clause allows the reinsurer to pay claims directly to the original policyholder if the ceding insurer becomes insolvent. This clause is beneficial to policyholders because it ensures they receive payment even if their insurer cannot meet its obligations. Question 11. Which of the following types of reinsurance contracts is designed to cover only individual high-risk policies? A. Proportional treaty. B. Excessive loss treaty. C. Facultative reinsurance. D. Quota share treaty. Answer: C. Facultative reinsurance. Explanation: facultative reinsurance is used to insure individual risks on a case-by-case basis. The reinsurer reviews each policy separately before agreeing to provide coverage. In contrast, treaty reinsurance covers a portfolio of policies automatically without individual assessment. Question 12. Under Ohio law, which entity is responsible for approving the forms and rates used by a reinsurer operating in the state? A. The National Association of Insurance Commissioners (NAIC). B. The Ohio Department of Insurance. C. The Federal Insurance Office (FIO). D. The Reinsurance Association of America. Answer: B. The Ohio Department of Insurance. Explanation. In Ohio, the Ohio Department of Insurance has the authority to approve policy forms and rates for insurers and reinsurers. This ensures that the rates are fair and not discriminatory, and that policy forms comply with state regulations. Question 13, scenario-based. Sarah Blake, an underwriter for an Ohio-based primary insurer, is evaluating a new quota-share reinsurance agreement. The agreement states that the reinsurer will assume 40% of all policies written. If the insurer writes a $1 million policy and a claim for $500,000 is filed, how much will the reinsurer pay? A. $200,000. B. $400,000. C. $500,000. D. $300,000. Answer A. $200,000. Explanation. In a quota-share reinsurance agreement, the reinsurer assumes a fixed percentage of both premiums and claims. Since the reinsurer's share is 40%, they will pay 40% of the $500,000 claim, which is $200,000. Question 14. Which of the following best describes a non-proportional reinsurance contract? A. The reinsurer shares both premiums and losses in a fixed percentage. B. The reinsurer pays only after losses exceed a certain threshold. C. The reinsurer assumes all risks regardless of the loss amount. D. The reinsurer covers specific policies chosen by the primary insurer. Answer B. The reinsurer pays only after losses exceed a certain threshold. Explanation. Non-proportional reinsurance, such as excessive loss reinsurance, requires the reinsurer to pay only when losses exceed a specified amount, the retention limit. In contrast, proportional reinsurance involves sharing both premiums and claims from the start. Question 15. Which of the following is not a function of reinsurance? A. Increasing the primary insurer's underwriting capacity. B. Reducing the primary insurer's exposure to catastrophic losses. C. Ensuring the primary insurer's compliance with state regulations. D. Stabilizing the primary insurer's financial results. Answer C. Ensuring the primary insurer's compliance with state regulations. Explanation. Reinsurance does not directly impact compliance with state regulations. Its primary functions include increasing capacity, reducing risk, and stabilizing financial outcomes. Compliance is the responsibility of the primary insurer and the state regulatory body. Question 16. What is the primary difference between a treaty reinsurance agreement and a facultative reinsurance agreement? A. Treaty reinsurance covers individual policies, while facultative reinsurance covers a portfolio. B. Treaty reinsurance automatically covers a portfolio of policies, while facultative reinsurance is negotiated on a policy-by-policy basis. C. Treaty reinsurance is more expensive than facultative reinsurance. D. Facultative reinsurance is mandatory for all primary insurers in Ohio. Answer B. Treaty reinsurance automatically covers a portfolio of policies, while facultative reinsurance is negotiated on a policy-by-policy basis. Explanation. Treaty reinsurance provides automatic coverage for a portfolio of policies, while facultative reinsurance is used to cover specific individual policies that require separate evaluation. Question 17. An Ohio-based reinsurer enters into a surplus share treaty with a primary insurer. The retention limit is set at $500,000, and the reinsurer agrees to assume 75% of any amount exceeding the retention limit. If a $1 million claim is filed, how much will the reinsurer pay? A. $375,000. B. $500,000. C. $750,000. D. $625,000. Answer A. $375,000. Explanation. In a surplus share treaty, the primary insurer retains a set amount, in this case $500,000, and the reinsurer covers a percentage of the remaining amount. The remaining amount is $500,000, and the reinsurer covers 75% of that, which equals $375,000. Question 18. Which of the following risks would be most likely to require facultative reinsurance? A. A portfolio of homeowners insurance policies. B. A high-value commercial property with unique risks. C. A fleet of personal vehicles insured under a standard auto policy. D. A group of life insurance policies. Answer B. A high-value commercial property with unique risks. Explanation. Facultative reinsurance is often used for large or unique risks that do not fit within a standard treaty agreement, such as high-value commercial properties. The reinsurer evaluates each risk individually. Question 19. Which Ohio statute governs the licensing requirements for reinsurers operating in the state? A. Ohio Revised Code 3905. B. Ohio Administrative Code 3901. C. Ohio Revised Code 3937. D. Ohio Insurance Guarantee Association Act. Answer A. Ohio Revised Code 3905. Explanation: Ohio Revised Code 3905 outlines the licensing and regulatory requirements for insurers and reinsurers operating in Ohio. It includes provisions for resident and non-resident licenses, renewals, and disciplinary actions. Question 20. Which of the following is a key advantage of using excessive loss reinsurance? A. It allows the primary insurer to increase its premium income. B. It protects the primary insurer from large unexpected losses. C. It eliminates the need for underwriting by the primary insurer. D. It guarantees the reinsurer will cover all claims. Answer: B. It protects the primary insurer from large unexpected losses. Explanation: excessive loss reinsurance is a type of non-proportional reinsurance that provides coverage when losses exceed a specified threshold. This helps the primary insurer manage catastrophic risks and protect its financial stability. Question 21. Which of the following is the primary reason for a reinsurer to obtain retrocession coverage? A. To increase the reinsurer's premium income. B. To transfer a portion of the reinsurer's risk to another reinsurer. C. To avoid regulatory oversight. D. To provide automatic coverage for all policies. Answer: B. To transfer a portion of the reinsurer's risk to another reinsurer. Explanation: retrocession is when reinsurer transfers portion of its risk to another reinsurer. This helps the reinsurer manage large exposures and spread the risk further. Question 22. Under Ohio law, which type of reinsurance agreement is required to be filed with the Ohio Department of Insurance for approval before coming effective? A. All reinsurance contracts. B. Proportional reinsurance agreements only. C. Non-admitted reinsurer agreements. D. Assumption reinsurance agreements. Answer: D. Assumption reinsurance agreements. Explanation: an assumption reinsurance agreement involves the transfer of an entire portfolio of policies from one insurer to another. This type of agreement requires regulatory approval in Ohio to ensure that policyholders are protected. Question 23. In a stop-loss reinsurance agreement, what happens when the aggregate claims of the primary insurer exceed a predetermined limit? A. The primary insurer covers all additional losses. B. The reinsurer covers all losses beyond the limit. C. Both the primary insurer and reinsurer share the losses equally. D. The agreement automatically terminates. Answer: B. The reinsurer covers all losses beyond the limit. Explanation: a stop-loss reinsurance agreement provides protection when the total claims exceed a specified limit. The reinsurer pays for any claims above that limit, helping the primary insurer manage catastrophic losses. Question 24. What is a cut-through clause in reinsurance contract? A. Provision that allows the primary insurer to cancel the reinsurance contract. B. Clause that permits the reinsurer to pay claims directly to the policyholder. C. Requirement for the reinsurer to assume all risks immediately. D. Mechanism to split claims between multiple reinsurers. Answer: B. A clause that permits the reinsurer to pay claims directly to the policyholder. Explanation: a cut-through clause allows the reinsurer to make payments directly to the policyholder if the primary insurer becomes insolvent. This provides additional protection for policyholders. Question 25. In Ohio, what is the minimum capital and surplus requirement for a domestic reinsurer to be authorized? A. $500,000. B. $1 million. C. $2,500,000. D. $5 million. Answer: C. $2,500,000. Explanation: under Ohio law, domestic reinsurers must maintain a minimum of $2,500,000 in capital and surplus to be authorized to conduct reinsurance business. Question 26. Which type of reinsurance provides protection against cumulative losses over a specific period? A. Facultative reinsurance. B. Per risk excessive loss. C. Aggregate excessive loss. D. Quota share treaty. Answer: C. Aggregate excessive loss. Explanation. Aggregate excessive loss reinsurance provides coverage when the total losses over a specific period exceed a certain threshold. It helps insurers manage unexpected high losses over time. Question 27. Scenario-based. An Ohio-based insurer has entered into a proportional reinsurance agreement with a reinsurer. The agreement specifies that the reinsurer will cover 60% of all premiums and claims. If the insurer collects $1.5 million in premiums and pays $1 million in claims, how much will the reinsurer pay in claims? A. $400,000. B. $600,000. C. $1 million. D. $900,000. Answer. B. $600,000. Explanation. In a proportional reinsurance agreement, the reinsurer covers a fixed percentage of both premiums and claims. The reinsurer's share of claims is 60% of $1 million, which equals $600,000. Question 28. Which of the following best describes the purpose of adverse selection in reinsurance? A. Selecting policies with the highest risk to reinsure. B. Ensuring all policies are covered by the reinsurer. C. Avoiding policies that are too risky to reinsure. D. Reinsuring only the policies that are most profitable. Answer. A. Selecting policies with the highest risk to reinsure. Explanation. Adverse selection occurs when the primary insurer seeks to reinsure only high-risk policies. Reinsurers typically try to avoid adverse selection by requiring treaty agreements that cover a broad portfolio of policies. Question 29. What is the primary regulatory requirement for a reinsurer to be considered admitted in Ohio? A. The reinsurer must have a physical office in Ohio. B. The reinsurer must be a member of the NAIC. C. The reinsurer must meet Ohio's capital and surplus requirements. D. The reinsurer must cover only high-risk policies. Answer. C. The reinsurer must meet Ohio's capital and surplus requirements. Explanation. To be considered admitted in Ohio, reinsurer must meet the state's financial requirements, including capital and surplus thresholds. Question 30. In a reinsurance contract, what is the purpose of a loss corridor? A. To limit the reinsurer's liability for claims. B. To share losses equally between the insurer and reinsurer. C. To allow the primary insurer to retain some of the risk. D. To provide automatic renewal of the reinsurance agreement. Answer. A. To limit the reinsurer's liability for claims. Explanation. Loss corridor is provision that limits the reinsurer's liability for claims within specific range. The primary insurer retains the risk for claims within the corridor, reducing the reinsurer's exposure.